Welcome back. You're watching the CNBC-TV18 budget coverage. We are here from the CNBC-TV18 budget headquarters. We're now joined by the team from North Block, the budget makers who have put the budget together. Joining us in the studio is the Finance Secretary, Mr. TV Somanathan, as well as the DIPAM Secretary. Many thanks, Mr. Pandey, for joining us. Mr. Somanathan, welcome to the program. Before I get to talk to you about the specifics, let me ask you about what industry seems to be picking up as the underlying message that the government is trying to send out. On the back of what the economic survey said, as well as what the budget is presented, sticking to the numbers of the interim budget, the message seems to be, we've done the heavy lifting as far as capex is concerned. We aided the recovery. We amplified the recovery. The baton is now yours to take forward. In that context, would it be fair to assume that there will be a recalibration as far as the government's capex spends are concerned?
Not necessarily. I think we have kept the capital expenditure provision at the same level as the interim budget, which is considerably above the actual expenditure in the last year. In fact, I think the step up is 17% compared to the actual expenditure of 9,48,000 crores. So there is a substantial step up in capital expenditure, but you're right, it is also a fact that the government alone cannot sustain capital expenditure in the economy. So that's true.
I get the fact that we have to look at these numbers also in the context of the fact that the interim budget was presented and we've got another 6 months before another
budget for a new year.
No, it is not a new budget for a new year.
About.
Absolutely. But so would it be fair then to assume that this kind of 17% number that we've done as far as capex is concerned, would this then now be the run rate on the back of the record numbers that we've done in the last 2 years?
Rather than look at a run rate, if you see the speech, there is a reference to the fact that we're currently spending about 3.4% of GDP on capital expenditure, and that broadly is something that the government wants to sustain. There is a reference to that in the speech. So that gives you the indication that as a share of GDP, capital expenditure, the endeavor would be to keep it at its present level.
Keep it at its present level. Let's now talk about the big tax changes, Mr. Somanathan, and that has to do with the LTCG changes that have come in, with the buyback tax changes that have come in as well as the short-term capital gains. Now, one of the big concerns that's being raised by investors, by citizens is, why have you done away with the indexation benefits? By doing away with the indexation benefits, you've dealt a body blow. I know you've explained the math that in effect, the rate will actually be more beneficial, even with the indexation benefits being done away with. But that's not how people are reading it.
They're probably reading it wrongly, I'm afraid I must say that, because it's not a body blow when you reduce a tax rate from 20 to 12.5. I think it requires quite a stretch to call it a body blow, because the tax rate currently is 20% with indexation, and the proposal is 12.5% without indexation.
Correct.
Now you're asking why no indexation? See, it's difficult to both demand simplification, rationalization, but please retain all the complications which I like. I mean, when you remove complications, you remove all complications. You don't remove the disliked complications and retain the liked complications. Indexation is a complication because we don't apply it to other assets. When you earn interest on a fixed deposit, do we tax you only on the real return? Is there no inflation in other assets? Is inflation confined only to property and certain assets? No, it's not. So what we have tried to do is that inflation in India is fairly predictable in the long run. We have checked that the average rate of growth of the cost inflation index, which is used for capital gains, is about 4.6%. So it's predictable. We know that on average your assets, for tax purposes, see, individual assets may go at different rates, but we use a steady index for tax calculations, which grows at 4.6%. Now let me give you a numerical example. I don't think anyone would make the case that property will appreciate less than a fixed deposit. That's not why people buy property. They buy property because it appreciates faster. And India is a land-scarce country. Property is bound to appreciate faster than most other assets. So let's say you expect property to appreciate at, let's say, 15% per annum. Take off 4% for inflation. Currently, with a 15% gain, you're taxed on 11%. Because every year you get a 4% knockoff for indexation. On 11% of the growth, you're paying 20% of that. So 2.2 is the tax that you pay. In the new system, you will pay 12.5% of 15%, which comes to 1.87. So it's lower. It's lower at almost any reasonable rate of growth for real estate, and we have calculated this. We have calibrated to be, in fact, for us it will be negative, because in most cases, the tax which would be computed on an indexation basis would have been higher than the tax on the non-indexed but much lower rate that we have imposed. So we've tried to keep it at a level where almost nobody will lose. A lot of people will gain because the indexation benefit will be less than the benefit that they would get. And one more thing I want to add. We will continue to start valuing property only from 2001. So it's not as if that benefit is taken away.
That benefit is not taken away?
That is not taken away. The value of the property will be the value as of 2001 or of the date that it was acquired.
Okay, that's an important clarification that you're making. But I want to stay with this, the tax change announcements that have come in. And, you know, there's been a lot of anticipation. In fact, even in the interim budget, the expectation was that maybe this would be the budget. The previous budget, the expectation was that maybe this will be the budget that you will finally announce as roadmap.
I'm glad to fulfill the expectation now.
I know. So the timing, I know that there is no perfect timing to increase taxes. But why did the government feel that this was the right time for you to be able to move towards what you call rationalization, simplification?
This is the time when we are looking at a Viksit Bharat in the next 25 years. In a country where we expect capital gains to be one of the fastest growing sources of income, and if you want a society without rising income inequality, and if you want a society where you have an elastic tax revenue, you cannot continue to ignore the tax potential of capital gains.
So revenue mobilization
it is one of the
considerations?
motives, yes, simplification and revenue mobilization. But simplification is the primary objective. If you look at it, we now have a very simple structure for capital gains. Everything that is long-term is 12.5%. Everything. Everything that is short-term is divided into two parts. Certain assets are at 20% and most of them are at applicable rates.
So
it's very simple. And everything that's listed is 1 year. Everything that's unlisted is 2 years, whether it's gold, property, unlisted equity, unlisted bonds, anything. So it's a very simple structure. You can actually draw a simple chart and decide your tax rate. But simplicity never comes simply. Simplicity is not simple. Simplicity is complicated.
Simplicity is complicated. But
to reach simplicity is complicated.
I would imagine that a lot of work has happened at the back end to that. But how much of this, and I want to build on the revenue mobilization argument because I heard the number 15,000 crores on account of the LTCG changes. What do you expect that number to be given the way that we are seeing, you know, the markets
Currently,
move?
our revenues from LTCG are very significant. Let me tell you that we are already getting significant revenues from LTCG. I'll mention two figures here. 88% of the value of capital gains earned in India, according to our study, comes from people whose returned income is more than 15 lakh rupees. And 62% comes from those who are above 1 crore of returned income. So this is not a tax which is falling predominantly on the not at all.
Class,
and this is the class of income which Thomas Piketty and others have been writing about all the time. Now, at some point...
It then begs the question, are you looking at a higher rate? Because that's the worry, that you've done 12.5. This is perhaps an odd rate.
If we were looking at a higher rate, we would have done it.
But maybe you're testing waters with 12.5 and maybe
we don't believe in testing waters.
So is it going to be 12.5 now for the near term? I mean, for the next few years?
There is no intention to revise it from here. I cannot speak for all the future finance ministers and finance secretaries, but I can say as of now, we have no intention of revising this any further.
So 12.5 is...
Of course, no one can predict the future.
No, absolutely.
Somebody else may cut it too. I can't predict that. But what I am saying is we need equity in taxation. We can't say that only equity markets take risks and a person doing an MSME business is not taking risk and he should pay 39%. And because I'm taking stock market risk, I should not even pay 12.5%. There is a case for a lower rate on capital gains tax. It is much, much lower than the marginal rate of tax on other sources of income. And it's creating distortion in the savings markets also. But no, this is not an intermediate station. This is the destination.
This is the destination, and that again is an important clarification because that was one of the concerns that could 12.5 become 15%.
We are definitely looking for simplification. Any simplification, if it is to be not revenue negative, cannot happen at the lowest of the rates. So we've brought down the rate from 20% in gold, 20% in property, 20% in unlisted equity. All of them de facto are reductions. Not for everybody necessarily. But for most people, the new structure of 12.5%, other than in listed equities, is a lower rate effectively. This is our calculation. That's why we anticipate, that's why we've calculated this rate. We have not put it at a level where it would affect other classes.
Okay, and that is the rationale behind 12.5%.
Yes.
But you talked about distortions, and one of the reasons why you brought in the 12.5% is also to avoid the kind of distortions that How concerned are you? We've heard now the SEBI chief, we've heard the RBI governor, we've heard the chief economic advisor raise the concern about excessive speculation, especially on the F&O side. You brought in the STT, higher STT on that
there
one.
There is a definite concern about, we are not concerned about investment. Investment in stock markets is welcome. But we are concerned about speculation. If it becomes, if it becomes more, the tail wagging the dog. And SEBI has expressed its concerns, and the change in the STT is a step in that direction. It may not be enough to handle what needs to be handled. That's a matter for regulators to look at. But we are certainly acting in that direction. Yes.
So again, I just want to pick up on what you said. You said that the higher STT on F&O is a step. So do you believe that more measures are required, which will now be taken by the regulators?
We would always prefer to raise revenues on something which is a win-win. So here we get revenue and we hopefully deter some speculation. So it's a win-win. That's why the STT is gone up.
Okay, I'm going to come back to you, but let me get the DIPAM secretary into the conversation as well. Sir, miscellaneous receipts at about 50,000 crores, pretty much the same number that we saw in the interim budget as well. Now, what happens to things like privatization? What happens to things like strategic disinvestment? Are we looking at moving ahead, moving forward with this, or is it, to be understood that asset monetization is going to be the preferred route?
I think as FM also announced to a question she replied in the press conference, there are certain decisions which have been taken by the cabinet in terms of moving towards strategic disinvestment. But she also mentioned about the timing. I think one of the timing and other issues are of important concern. Now, what we have been looking at is what is our time frame for doing capital management. We have moved from pure disinvestment to holistic capital management, and it has got a certain number of pillars. The first pillar is look at your enterprises and concentrate on performance. Many of them are listed. If you overall, we have 81 listed CPSEs, banks, and insurance companies. Their market cap was of the order of about 12 to 13 lakh crore 3 years back. It commands about 73 lakh crore now. And one of the factors has been the fundamentally, number one, looking at performance, looking at the management of capital in the manner in which it is normally done in listed companies, aligning the management incentive to the, to the performance, their bonuses, their performance bonuses. Capex, there was a mention about 11.11 lakh crore, which is a government capex.
Correct.
You have to add actually 3.9 lakh crore of capital assets, which is basically, designated as grant, but actually is a capital assets because it's a part of the schemes given to the states. On top of it, there is about 3 lakh crore, which is also invested in capex by the CPSEs. So you have, the capex, which brings in growth and the capital thing. So overall, and then we have a fourth pillar is consistent dividend policy. And the fifth is calibrated disinvestment strategy. Now, when we say disinvestment strategy, it is a different, continuum. It's not merely privatization. We call also listing, then also market dilution while the government is in control. So we are looking at a time horizon, which is a much longer term, and in which, you can also, part with certain equity, you can also collect dividends, you can also improve performance, but on top of it is a value creation. If you don't value create, because I think the CPSEs and other things, they also do participate in the economy, which is growing. And they must also grow in tandem with the economy.
No, fair enough. A quick question on IDBI Bank, because that, of course, has been waiting for several years now. We are given to understand that the RBI has come back now with the clearance on fit and proper. Is the next stage set as far as IDBI Bank is concerned?
I think RBI is in an advanced stage of doing it. And I think we will move forward.
They have not actually come back.
They have not come back. Okay, so it's still...
they are almost there, but then they would let us know, and we will move to due diligence stage and move forward.
So can we expect that to be done in this financial year?
Hope so.
You hope so. So perhaps there is hope for IDBI Bank. Let me now address some of the other announcements. And I want to address the announcements related to the employment schemes that the government has announced.
Yes.
How hopeful are you of take from the private sector, participation from the private sector on the back of the incentives. Now, no one's going to hire primarily because the government has put incentives on the table.
No.
How confident do you feel about these schemes taking off, and how soon do you see them being operationalized?
So, look, whenever we get requests for tax concessions like investment allowance or tax concessions for R&D, what we are told by the corporate sector is that we respond to incentives. We'll spend more on R&D if you give us incentives. We will spend more on capital equipment if you give us investment allowance. So, and this is normal, and it's nothing wrong. I mean, what they're saying is true, because economic agents respond to incentives. Will somebody set up a plant just because there's a depreciation allowance? No. But will it encourage people to set up more plant if there is a depreciation allowance? Yes. Similarly, people may not hire because there is an incentive, but there are two things. One, if you're planning to hire, you may expedite hiring to take advantage of an incentive, number one. Number two, even in capital incentive sectors, and there's a lot of economic evidence on this, the exact extent of mechanization or automation is not fixed. So somebody may be 60% mechanized, somebody may be 100% mechanized with robotics. That marginal decision of labor versus capital is often influenced by incentives. And incentives are something that industry legitimately looks for as a signal to what is the direction of government's policy. And if it aligns with what they want to do, then they respond. There is no compulsion.
I understand there's no compulsion, but I'm asking you this in the context of what the survey highlighted. It says that while corporate profitability has quadrupled in the last 3 years, the pace of hiring or compensation hasn't kept pace with that. Given where capacity utilization is today, do you believe that we are likely to see, even on the back of the incentives, a takeoff of these?
I definitely think that there will be a takeoff. I'm almost certain there will be, because again, a lot of the evidence shows that there are a considerable amount of labor shortages in this economy. We've seen lots of reports saying that people are short of this skill, that skill. So there is a mismatch between people wanting jobs, industry wanting skilled people, and the availability of skilled people. Now there is a role for the government in bridging that gap. Can the government do that simply by itself? It actually cannot, because the government is not in a position to provide some of the skilling that the employee needs in order to reach the employer who wants him to come. Nor is it the job of the company to do general skilling as an externality for others. So what we've attempted here is, one, we have two schemes which are focused on first-timers. Now, as anybody who has been in the job market knows, if I don't have a previous experience in my CV, it's more difficult to get a job because I don't have previous experience. We want to incentivize companies to take those people if they can, because we're providing a subsidy. The company can calibrate its pay package because they know the employee is going to get this subsidy, which helps cover that initial learning curve where a first-time employee is not as productive as somebody who's being rehired from somewhere else. So it's a fillip, an encouragement, an incentive to take people who are not previously employed. So, and fiscal incentives, at least everything that I have learned in my career from industries, they respond to incentives. They say this all the time. R&D, give us a tax concession, we'll do more. So employment also, I believe they will. That's one. Second, the other two schemes have very substantial incentives. The B and C. B covers 72% of a person's salary, annual salary, is the extent of the subsidy. So there, if you hire at least 50 people or 25% of your existing strength, we will cover 72% of one person year's salary. Now, why is the incentive so big? Because we expect then that industry will use this subsidization to perhaps do some of the skilling of this person that the ecosystem is not yet providing. So this is a win-win. The person gets skilled, joins a company, but that adds to the skilled pool. And similarly, the last scheme, which is the internships. Now, the internships are going to be funded primarily by the government. The government provides the money for the intern. The company is not expected to absorb this intern. That's not the intention. But just imagine how many opportunities can be opened to people who don't have access to this and who are spending their time only writing maybe government exams or are not even aware of the opportunities in the private sector. If you can orient at least some of them, and not necessarily only those who are writing exams. Nothing wrong with writing government exams. What I'm saying is there is a whole range of careers. There's a lack of exposure to these careers, and we want them to get exposed, do some skilling through good companies which will do a good job of skilling, produce skilled people whom some other company may employ. It doesn't have to be these. And these companies can do it because they have considerable CSR expenditure. We have done an analysis. 50% of India's CSR expenditure comes from the top 100 companies. So if they can devote some time and effort to this without affecting their bottom line, without charging it to their profit and loss account, it would be a win-win both for industry, for government, for the people, and for the country.
You know, and I think unequivocally, the message coming in from people who watch the budget is that it is a vote for continuity, but more importantly, it's a vote for stability as far as macroeconomic policy is concerned. 4.9% on fiscal deficit, and you know, that was the hope, but the budget is delivered on that, and you've said that you will get to 4.5% as well. What are the risks that you see to the fiscal consolidation glide map that you've laid out?
Between now and next financial year, of course, the risks are I do not see very serious risks between now and the next financial, unless there is some external exogenous convulsion, which can happen. I mean, you have an election going on in an important country, you have wars going on in two places. Those are things which one can't predict. But based on what we know up till now, and if there are no major commodity price shocks or no major macroeconomic disruptions in big economies like the United States, I think we are on course to achieve the intended consolidation.
You know, the changes that you've made as far as the salaried class are concerned, with the changes in the new pension, tax regime, and the hope is that you will see more people pivoting now. Do you get that feeling? Do you believe that you've done enough? Huge
pivot has already happened. Up to now, 70% of the salaried returns that are coming in for the current year are in the new regime. So the pivot has happened. Now it's the new regime is now not merely the legal default, it is also the most popular option. So we have, that change has happened.
And the income tax review that the finance minister spoke of, and she said that 6 months is the window that has been given. That's a pretty big...
It is a bold and ambitious task.
An ambitious task. So would it be fair to assume that perhaps we could see this being taken forward in the next budget?
It's a possibility.
And on the scheme, on the pension changes that you're working on, I know that the balance of being fiscally prudent, but also giving into some of the concerns that have been raised, how soon do you believe you'll be able to arrive at a viable solution, sir?
I am unfortunately not able to give you a timeline, but it's at an advanced stage.
At an advanced stage?
Yes.
How confident do you feel about being able to get to this 50,000 crore rupee number, Mr. Pandey?
Well, this is a number, as you say, is a miscellaneous capital receipts, includes, different types of capital receipts which can come either through disinvestments or asset monetization, and we hope to achieve.
And anything else besides IDBI Bank, which is which has been on the burner, so to speak, and is likely to see a culmination?
No, I think we will just go along with that, the ongoing transaction, and see to it that they are culminated.
Gentlemen, I have much more to ask you, but unfortunately we're out of time. But we will see the two of you at the CNBC-TV18 budget verdict. Appreciate you joining us here today at our CNBC-TV18 budget headquarters, Mr. Somanathan and Mr. Pandey. Thanks very much. We're not done with the budget makers just yet. We are going to take a quick break, but the team from North Block will continue to decode the budget fine print right here with us. We're back in a moment.